Welcome to this edition of Cattle Call. I'm Susan Littlefield. Hoping everybody had a great Thanksgiving and started to move into this month of December and work towards the holidays. We've got a variety of interesting things that we're going to talk about today. Looking at the packer margins, there is some frustration going on in this marketplace. Add to it the COVIDs and the shutdowns and the upcoming issues that it could mean for the proteins, especially this cattle market. That is just the tip of the iceberg of the things we're going to talk about today with Brad Kooima. As you can see him on the screen with me, he is with Kooima Varilek out of Sioux Center, Iowa. So let's start here. Packer margins, what are your thoughts?
Well, um, I was hoping we could put this issue a little bit to rest after the Holcomb fire, after the effects of the COVID shutdown, and here we are again with boxes here at 240 something, and we're trying to beg our way to try to get maybe $1.10 for cash cattle. The issue here is leverage, or the lack thereof, in my opinion. The cattle producer, particularly the guy that is paying the price of being the negotiator, the cash negotiator, continues to struggle because there's too many cattle that are committed and turned in various deals, whether they're formulas or whether they're high of the week or a plus $1 over the week. All these deals out there is allowing the packer to gain a lot of leverage and get long bought to the point where he never really feels like he's stressed enough to have to go ahead and chase cattle. So it's a tiresome thing to talk about. It's troubling for the industry, at least it is to me. But yeah, the packer's got plenty of margin. He could pay $1.25 or more and still have lots of margin.
But is this frustration going to continue into the new year?
Well, it'll continue until the producer can get a little leverage. Now, one way that can happen, Susan, is that we could have less cattle. I hear that a lot. Well, we just got to have less cattle. I'm thinking, yeah, well, tell that to my cow-calf customers. That sounds like a great idea. That's what they want to hear, right?
Right.
I think it would improve if we would just buckle down and commit to indeed doing more negotiated trade. And of course, as we continue to work toward that, I will keep you posted. It's a problem that, it's like turning a giant ship around, right? I mean, progress is slow. I think we're making a bit of progress, but until we tighten the numbers up. Now, you've had 2 years of big cow liquidation. You've got a steer and heifer ratio on feed right now. This is maybe boring to people, but it isn't to me because it's the stuff. It's the macro stuff that the market's about. So it appears to me, at least, that you've tipped over that expansion now to where we're starting to dip into more of a liquidation phase where, as we look forward to next year, and especially the third and fourth quarter of next year, there probably is less cattle. So hopefully we've got a little leverage back there. Hopefully we're still standing, for a chance to make some of that back that we've lost this last 15 months.
Now, the fact that COVID continues, and we know that it's having some ill effects. We saw some numbers coming out today about the number of people that have lost their jobs in the restaurant market, which in a roundabout way comes back right to this cattleman and what they're seeing in their prices.
You make a great point, Susan. To me, the issue moving forward here in the very near term is that typically we would start a rally about the second week of December or a little before. That was usually pushed on, led by increase in the amount for the middle meat, the high end, the tenderloin, the prime rib, for the office party, the Christmas party, the New Year's Eve party, and that usually would trail all the way into potentially all the way up until just before the Super Bowl. So you'd have this push in the demand and led by the highest priced part of the product. What's it going to look like this year? Well, pretty good chance there isn't going to be a big office party, right? There's still going to be some Christmas parties and things like that, but there's no denying that this is going to look a little different this year. Now, I'm not suggesting that I think demand is bad, because it is not. When you have a choice select spread at $20 this time of year, when you're producing a lot of choice because of the average weights, because we're not really very current. That's the boogie that's the gorilla in the closet, right? The boogeyman. Our weights are too big. And a lot of that's because the weather's been perfect. Cattle growing, my dad used to say 3 pounds a day and 2 more pounds at night, when the weather was this good, right? They're doing it all. So as we move into this first quarter, to me, that's where the question mark as an analyst is. Normally, I always have high expectations going into February cattle. You got weather risk. So far, we haven't had any weather. You go on typically into tighter numbers this year. It looks like we're going into a little bigger numbers. We're going to have more numbers in the first quarter than we did in the third quarter. It's because of the whole complication of backing up the placements, and that goes all the way back to the fire at Holcomb, and was even more, mitigated because of the COVID problem in the spring and the summer. So we've got an interesting first quarter coming at us. Now, if we can kind of get through that, I've got an awful lot of enthusiasm starting, particularly in the third and fourth quarter. But yeah, we've got to get there first.
Are we going to continue to see a pickup though in the cash market?
Normally we would in December, starting about the second week. We were a little higher today. Finally got 112 out of Texas. It feels like just pulling teeth. The North continues to, I think, be somewhat left to our own demise here a little bit. We've got a few cattle that are a little bigger than the packer wants to buy. So we continue to struggle with that. But even though that class of cattle today was a little higher than it was last week, Susan, so grudgingly, I think the cash market will grind a little higher yet going into the end of the year.
You and I, before we started the cattle call today, you brought up an interesting point about the beef and the pork market. At one point they were kind of married together, but they've taken separate paths.
Yeah, well, I've got enough gray hair, been at this long enough to remember. It used to be a really big deal, the competitiveness between when pork and beef are priced much differently. Now, I just happened to notice it today because it's more than 3-1 again. Beef 3 times higher than pork product. And I don't know that I don't think it's the market influencer that it was 15 or 20 years ago. And I think that's generally unfortunately, to a degree, the sad state of our economy, where there's the pork has turned into an item that is really for the very budget conscious, and the beef not so much. But when 3-1's a lot, we either gotta grab this pork product by the nose and drag it along. That's what I'd like to see happen. I hope it isn't the other way around, where the attitude is that the beef is too high.
Well, as we wrap up, your final thoughts on the back months and what's going to mean for our cattle guys? Well,
if you've got some of these line drawer geeks out there, the chart guys, which I throw me in that camp too. I'm not just a fundamentalist. We do have a chart pattern in some of the back months. I think June is maybe if the guys want to pull out their charts, or gals, and take a look at it. We've got the potential for a head and shoulders, inverted head and shoulders formation that projects to the upside. We'd probably, bear with me, I'd say you'd have to take out 112.60 to confirm the breakout. Sorry about that. I was running my own chart up there. And that would project to 117 or 18, which would be a tremendously nice spot to get a bunch of hedges off. So from a fundamental standpoint, I would be more friendly the fourth quarter. I think by that time we'll have significantly less cattle. We should be on the backside of this stupid COVID thing, hopefully. And then maybe we get this market back to where it belongs, which is like 125 or 130.
All right, sounds good. Thanks so much for joining us this week, Brad.
Of course, thank you.
That's Brad Kooima joining us for this week's Cattle Call. And just a reminder, commodity futures and options do involve substantial risk of loss, and they're not suitable for all investors. Enjoy your week, and we'll be back next week on Cattle Call.